This is week 3 demonstration problem. What we need to do is take a look at page 150 in your text, and this will guide you through how to do this exercise. We're using T accounts. Now, T accounts were invented back in the day, supposedly by 12th or 13th century monks, as a way of keeping track of expenses and revenues for a monastery. I don't know if that's an urban myth or what, but that's what was told to me. On one column, it's called double entry accounting for the main reason it's easy to make mistakes. People back in the day were doing this stuff by hand, and as you can imagine, when you're making entries, hundreds of entries a month, it's very easy to make a mistake and throw off your books. That way, you have to make an entry twice for every transaction. One account goes up, and there has to be an offsetting account as well that coincides with the initial entry. So we're going to look at our exercise this week, which is just the demonstration problem for week 3. Company issues common stock for $5,000 cash. Now this is very similar to the horizontal financial model, but a little different. What we're doing is you're keeping in mind is asset, liability, and equity. And if you look at page 150, you'll see on panel B, you'll see assets, liabilities, and equity. And you'll see all the accounts under equity: revenues, expenses, dividends, and common stock. Those are equity accounts. And there's a few accounts under assets as well, such as accounts receivable, cash on hand, real estate, prepaid rent, things like that. Those are all assets. Liability accounts are going to be bank loans, accounts payable to creditors, things like that. Those are liability accounts. And as you can see in panel A, that's going to tell you how to increase and increase each type of account. So we're going to start with the first transaction. Issued common stock 5,000 cash. So we're going to create a cash account right here. This is a cash account, and it looks like $5,000 cash goes up. We're going to increase the debit $5,000 because, again, look back to page 150, how to increase an asset account. You increase the debit. Now remember that the assets always need to equal liability plus equity, so the debits need to equal the credits. So if we look at the equity section, and we call it common stock, we're going to put it under credit, $5,000. $5,000 under credit. Therefore, our balance, clean that up a bit, our transaction stays in balance. Debits equal credits. Debits are going to equal credits. Always keep that in mind. The next transaction is going to be, you're paying $1,800 cash to rent office space for 1 year. So what's happening is you get a landlord who wants cash up front. They want cash up front for 1 year. So February 1st, what's going to happen is you're going to pay cash. Cash is going to go down $1,800. Cash will go down $1,800. But then we have a prepaid rent. And prepaid rent is going to be an asset. The reason why prepaid rent is going to be an asset is because you have access to it. You have access to that property for 1 year. Okay, so you have $1,800 in rent. That's an asset account. There's 3 types of transactions: asset source, asset use, and asset exchange. That's back in chapter 1, I believe. Asset source is revenue. You get money in. Asset use is when you pay bills, you pay expenses. That's a use of assets, so cash is going out. An asset exchange is when you take cash and you acquire another asset with it. In the whole asset column, nothing changes. It stays in balance. This right here, prepaid rent, is an asset exchange. Cash goes down and debit goes up. Prepaid rent goes up. So that's what happens. Now, we receive $2,400 cash advance as a retainer for services to be provided. Services were to be provided evenly for 1 year beginning March 1st. So $2,400 comes in. $2,400 comes in. Cash. So we're going to increase cash. Now, we haven't performed the work yet. The work has not been performed yet. So we're going to create an account called unearned revenue. And why would we create an account called unearned revenue? I want you to think about that for a moment. The reason why is because if we don't do the work, we owe the money back. If we don't do the work, we owe the money back. So what we do here, unearned revenue, we increased it over here, the $2,400 cash, and we're going to increase it over here, $2,400. So right now that stays in balance. Debits on the asset column equal credits on the liability and equity section. The balance sheet is still in balance. Then we pay dividends to stockholders. We pay dividends to stockholders, $200. We pay dividends to stockholders, $200. Cash goes down, $200. And that's a common stock account. We're going to call this retained earnings. Remember, dividends come out of retained earnings. Retained earnings. And that's going to go up $200. So it's going to go up, page 150 of your textbook, $200. That stays in balance. So if you add up all the debits and all the credits, if we did a journal entry, which we can get to later on, you'll see that all the debits and credits balance out, and your balance in your the double entry accounting system is in balance. Now what the book is asking us, or the exercise is asking us to do, is we're supposed to make some adjustments, make the adjusting entries. This is all about adjusting entries here. So what we want to do is, the first thing we have to adjust to close out the year is we're going to look at the rent. If we look at the rent, that's $1,800 for the year. And if you just take equal sum, divide it into 12, that's $150. You're paying $150 a month for rent. Okay? Now I want you to ask yourself, what you're going to have to do is, you see revenues, expenses. I want you to look at the right-hand column on page 150. I want you to look at the equity, under equity, common stock, dividends, revenues, and expenses. We're going to create, under equity, we're going to create an expense account. Actually, I made it, give me 1 second here. And that is expense. All right. So what we're doing here is we have expense. We paid rent $1,800 a month, $1,800 for the whole year. Now what we're doing is we're going to close out the books for the year. And as you can see in the problem, it says we paid that on February 1st. So February through December, the end of December, that should be what, 11 months? February, March, April, things like that. So that's 11 months. So we have to figure out that the prepaid rent is going to go down. We're going to bring the prepaid rent down because we gave up most of the asset throughout the year. We used up the prepaid rent. So we're going to bring down the prepaid rent. The first thing we're going to do is 150 times 11. We know we're paying $150 a month. Okay, we know we're paying $150 a month, and I'm just using this Excel formula to do the math for you. We know we're paying $150 a month. We rented the place for 11 months. Okay, that's $1,650. So we used up $1,650 worth of the prepaid rent. So now we only have, well, I'll get to that in a second. So now we have to offset this transaction. We just created a credit. We decreased our assets by $16.50. Now we need to offset the assets. So if you look at page 150 of your text, how do you increase an expense? How do we recognize in the T accounts that we paid $16.50 for rent throughout the year? If you look down on page 150 again, under expense, to increase expense, you debit it. So $1,650. Okay? That's what we paid. That was our expense for the year. $1,650 right here. That was our expense for the year. Now we have to close out these accounts. We have to close out these accounts. So we start closing out the prepaid rent as of December 31st, 2012. So we're going to look at, or December 31st, 2013, whatever year it is. Actually, the problem says it's 2012, yeah. So as of 12/31/2012, we have to start ending balance. Ending balances. We have to start closing these transactions out. So the first thing we're going to do, closing these accounts out. So the ones that have one entry are pretty straightforward. We know that on the income statement, it's going to show $1,650 as expenses, $200 out of retained earnings for dividends. We raised $5,000 in common stock issuance. And what we do is, what's left over on this one, prepaid rent, is $150. $150. That's the ending balance. And it's a debit. So we still have, as of December 31st, 2012, when we open up January 1, 2013, when we open up the new year, and we're going to have a prepaid rent T account, we're going to have a debit balance of $150. And then the month of January, we'll use that, and the same thing. As of the end of January, we're going to bring that down to credit $150, make it a zero balance, and we're going to have an expense of $150 increased. That's how to do an adjusting entry. Now what I need you to go ahead and do is do the same thing for the received $2,400 worth of cash as a retained service. So what you're doing is, there's 10 months left in the year, March through December. So figure out how much $2,400 is going to be throughout a 12-month period. And once you have that, you have to figure out you've done 10 months worth of work. So you're going to need another account in here, and that's going to be revenue. Debit and credit. You're going to need a revenue account. And I'm not going to do it for you. I need you to do it. And so what you're going to have to do is, even enough. That's even enough. Okay. What you need to do is you're going to have to figure out how much work you've done throughout 2012, the 10 months in 2012, and you're going to capture some of the revenue in here, and you're going to decrease this amount, and then you're going to increase the revenue amount. You'll increase the revenue amount, just like what we did with the prepaid rent. And then the cash will stay the same because you've already gotten the cash in, but what you're doing is you're recognizing revenue throughout the year. So again, there's 10 months worth of work in the year. You've been paid for 12 months up front, and then also try to figure out going into 2013 what the unearned revenue balance is going to be. So what you're doing here is you're going to do an adjusting entry for unearned revenue. I've done the first one for you, and you're going to do the second one. You should be good to go. Any problems, email me or call me, and I'll walk you through it. Best of luck. Thank you.